Welcome to Business Authority Radio, bringing you insights from today's thought leaders, professionals, and influencers. With your hosts, Neil Howe and Craig Williams.
Hello and welcome to the show. This is your host, Neil Howe, and today my special guest is Jack Husney. Jack is a CPA from New York. He has two offices in New York, one in Midtown Manhattan and another one in Brooklyn. He has been in public accounting for over 9 years, and we have lots of questions for him today, especially about this new tax bill. So welcome to the show, Jack Husney.
Thank you very much, Neil. Thanks for having me and for the invitation. I appreciate that.
Well, let's get right to it. Tell us a little bit about yourself, how you got going in accounting, a little bit about your background and your education there, and of course, what kind of clients that you help.
Sure. So I've been in public accounting since 2009. I first started at a small tax office in Brooklyn, New York, primarily dealing with individual tax returns, where a lot of our clients were just middle income people within the area looking to get their tax return done. So I first started being as an assistant, and then I was there for 4 tax seasons, which I ended off actually preparing returns for certain individuals. Right after that, I moved to a small firm in Midtown, New York City, where I started just doing financial statements, bookkeeping. And then by the time I finished, I was doing tax returns representation before the government, the IRS, New York State, and some tax planning as well for individual returns, business returns, individual returns, those middle income to high income, and business returns from the couple 100,000 revenue to revenue of over 100 million. So it was a wide range. I graduated from CUNY Brooklyn College. And I recently just opened my firm on my own, as you alluded to, Neil, just a couple minutes ago. I have an office in Midtown Manhattan, as well as Brooklyn, New York. And with this new tax law that just passed at the end of 2017, there's definitely a lot to cover. So let's get right into it.
Yeah, definitely. So would you say most of your business is still dealing with individuals and their tax returns, or you deal more with businesses, or is it an even split?
Yeah, it's not an even split at the moment, but it's primarily individuals as well as small businesses with revenue in the couple million in revenue to, businesses just starting out. I deal with startups. I deal with businesses that have been in business for a couple of years to those that have been established for 5-10 years. So that's my sweet spot is the small businesses and individuals at this time. But I'm always looking to expand. That's where I'm at the moment.
Well, there's certainly a lot of small businesses out there that need tax help. So let's talk about some of the major problems that small businesses have when it comes to tax. I know some individuals will try and do their own with some of the free software and things that you have online, but once you really start getting into business, it does require somebody that's a little bit more knowledgeable when you're dealing with more figures and more numbers. So tell me a couple of the problems that most businesses encounter and why they need a CPA to work on their taxes.
So, the first thing that I've seen is a lot of business just do not put enough attention to their managing of their books. Their books is their most important part of the company. Not just for the tax return, just to know your day-to-day operations. Are we making money? Are we losing money? Who is our big customer? Which customer are we not making any money on? Where are we spending our money? By reviewing your profit and loss statement, even monthly, quarterly, even semi-annually, you have an idea of where the company is going, because just because money's in your bank account doesn't necessarily mean that's the profit of the company. So a lot of businesses just fail to see the importance of proper bookkeeping. And then not just that, when it comes time to do the tax return, it is just a mess. They're just scrambling, and that's the biggest struggle I see, especially with small businesses, is they just get right into it. And a lot of the time, when you just deal with a tax preparer, whether you do it on your own or you deal with some of these small offices that are just there 3-4 months a year, you have a question in the middle of the year, those guys are not going to be around for you. As opposed to a certified accountant, public accountant like myself, I'm around 12 months a year. I'm not just open during the season. I close up shop and I'm sitting on a beach in the Bahamas or in the Caribbean. I'm in the area.
That's it. Yeah, you often see all these offices opening up, and they're just hiring people and training, giving them maybe a couple of weeks training to do people's taxes, and that may work for individuals. But another question I had about the business is: do you often see businesses that are making a lot of money be so unprepared with their bookkeeping?
Yeah, I mean, businesses might be making a lot of money, and it comes the end of the year where I have to tell some of these business owners, you owe this amount in tax, and they're like, we didn't even expect this. We had no idea either we were doing this bad or this well. And then, after the year's over, right? After the year's over, there's practically no tax planning you can do going retroactive. I mean, there's certain retirement plans you can do, but there's some strategies in terms of, do I take the expense in 1 year over the other? After the fact, it's way too late. So that's why December, in my practice, is becoming one of the busier months, because I reach out to all of my business clients, say, okay, let me see how the year is going. What can we do within the last 4 weeks of the year to potentially give you an additional expense, to potentially reduce your tax liability, or maybe let's put money more in retirement, or come up with some sort of strategy to minimize the tax situation and keep more in the business owner's pocket. Especially with this tax. I'm sorry, go ahead, Neil.
Yeah, so let's talk about that strategy. What is a good strategy for a business that, is making a fair bit of money throughout the year, and they know they're going to have to pay a chunk of taxes? What is the best strategy throughout the year for them to follow?
Well, one of the first things they want to do, they want to make sure that their books are up to date. I've heard business owners said, I thought we made this amount of money, and then we review the books, and it's the complete opposite. Or someone says, we didn't make any money, and when we review the books, it's a substantial amount of money. So the first thing in order is getting your books in order. That's something I do for a lot of my clients. I do it depending on how they would like the books, whether they want it monthly. Most of them prefer it quarterly. But some of the strategies is, if they get bills in December, does it make sense to pay it in 17 or 18? And for and this past tax year is more beneficial to pay the expenses in 2017 because the rates are on a much higher level, so you get more of the benefit when there's a higher tax year. For 2018, all the tax brackets have dropped. The main one is for corporations. The highest corporation rate was 35%. Now that rate is dropping down to 21%. So if you're a C corporation, that's a substantial savings. As the news within the last couple of weeks, the larger companies have been giving bonuses. They're rethinking their ways because they have a lot more available cash now, and they're passing that cash down to the employees. On the individual side, there were 7 tax brackets, and in the past law and in the new law, there are still 7 tax brackets, but the percentages have decreased. Mainly in the top percentage, it's going from 39.6 down to 37%. So it's a bit of a 2% drop on the highest tax bracket, but along the lines, it's still going to be dropping regardless of your income. So that's great news across the board for a lot of individuals, as well as businesses as well.
Yeah, it definitely seems great, a big cut for businesses, which means, they're going to be able to put that money elsewhere in creating new things. So what has this new tax bill actually done for businesses? You mentioned that they're giving some bonuses to their employees and putting money in the individual's pocket, which is great. But what is the bigger overall benefit for business?
Well, it first depends on what type of business, the way the company is structured, if it's an LLC, an S Corp, or a C Corporation. So I'll begin on the C Corporation. A C Corporation is known as the entity that gets potential double taxation, in which the company pays the taxes, and if any of the shareholders take any money out, it gets taxed as dividends on their personal tax rate. So that's where the term double taxation comes up. So in terms of that, for C corporations, they're the top bracket drops from 35 to 21. There's something known as the alternative minimum tax for businesses, which plays in when certain businesses have a substantial amount of deductions compared to their overall income. That alternative minimum tax for C corporations is now eliminated in 2018. There's something known as Section 179, which allows businesses to make capital improvements and have the ability to deduct a substantial amount of those the purchase in 1 year. So in 2017 and prior, businesses were able to expend in 1 year $500,000 of qualified assets. In 2018 going forward, it's now over $1 million. So a company can buy assets of $1 million and under and take the full expense in 1 year rather than capitalizing it. So this allows businesses to invest more potentially and get the full write-off in 1 year, as opposed to having to take 3, 5, 15, substantial amount more time. So in my personal opinion, I could see businesses spending more in manufacturing, getting new equipment, new vehicles, upgrading computer systems, stuff along those lines. So that's on the C Corps. Something for the LLCs and the S corporations, those get taxed on the individual level, but as part of this new tax plan, there's going to be now a 20% deduction for these flow-through entities, which are LLCs and S Corps. Now, the way it works, it all depends on, there's different ways that this number gets calculated. And without getting into so much detail, we'll just go on a simple example that if a company makes $100,000 in pass-through income, that 20% deduction means the individual on their personal return pays tax on only $80,000. $100,000 minus 20% deduction is on $80,000. Now, it just depends first on the way the entity is structured. For a sole proprietor, obviously they don't get any salary, so 100% of, going back to the example, they'd be paying tax on $80,000. For S corporations, there's another way of calculating it. Is there's also limitations on the individual level. So it depends on what your personal tax rate, your taxable income is. That's one of the ways where this deduction you may get the full benefit, you may get a partial benefit, or you may get no benefit. Mm-hmm. So this is another way. It's a little too complicated for this interview to go into so much depth, because this conversation by itself can go in excess of an hour. Right. But there's something now for flow-through entities that they can potentially, depending on where their company is, they can get a potential 20% deduction of the income that the business has.
Well, let's just cover what flow-through is for those people that are listening that might not quite know what that is. Can you explain that?
Yeah, sure. So flow-through entities are primarily LLCs, limited liability companies, as well as S corporations. Whatever the company, the actual company pays zero federal tax, and all that income or losses, hopefully there aren't many losses, they flow through down to their personal return. So for example, if I'm an S corporation and my company makes $100,000, on the S corporation tax return, I'll have zero federal tax to pay, but I'll pay all that $100,000 on my personal return combined with any other income we have. So This is the opposite of a C corporation. A C corporation, you pay the federal income tax, but you don't pay any of it on your personal return, while the S corporation, you don't pay anything on the business return, you pay it all on your personal return.
And it just depends how you set up your business as to
Correct.
Which one you have to pay. So
correct. It depends if you want to be, if you're a single member LLC, if you're a multi-member LLC, if you have multiple shareholders. S corporations have strict rules. That's why certain companies cannot be S corporations. One of the top reasons is you need to have 100 investors or less. So that's why you don't see any of these larger companies be S corporations, and all the partners need to be U.S. citizens. So if you have anyone foreign, your company cannot be an S corporation.
Okay, so let's talk about the main benefit for 2018 for, the individual first, and then we'll go into the businesses. What's going to be the biggest benefit an individual will see, and what should they be looking out for in 2018 when it comes to doing their taxes?
So Neil, the first thing first is the average American will see their paycheck go up, and because there's now less federal tax being withheld. The IRS is still figuring this all out because the tax plan passed in late December, so they're still trying to figure out, but they said in early to mid-February, everyone should be seeing an increase in their paycheck. Now, within their paycheck, their Social Security and Medicare taxes withheld. That's not going to change. That's still the same percentage, but it's just the amount of federal tax that's going to change. So for certain individuals, it all depends on their situation and the state that they reside in. Just let's try to do the basic. And if someone has a single individual, let's start with a single individual to strictly a W-2, their tax return isn't going to be changed much, except the percentage is going to be going down. So one thing that's their percentage, their tax bracket is most likely going to be decreasing. There's something known as the standard deduction. The standard deduction is now being doubled to $12,000 each year. So if your income is $100,000, you remove $12,000, so you're only paying tax on $88,000. But one thing that is now eliminated is a personal exemption, where in past years it was approximately $4,000 and up. So depending on your situation, you can be saving a lot in tax, or you might have a very minimal increase or even slight decrease. So another thing that's changing is the itemized deductions. This got a lot of news towards the end, as this plan was passing, because there's something known as SALT. Not the salt you put in your food, but state and local taxes, and as well as real estate taxes. So in past years, under the old tax plan, you were able to deduct all of it on your Schedule A if you itemized your tax return. Now in 2018, the combined deduction if you itemize is just $10,000. So $10,000 is what you pay to the state and local taxes, as well as real estate taxes. So states like New York, New Jersey, Connecticut, California, where they have high state tax and potentially high real estate taxes, the maximum deduction you can get now is just $10,000. So states like that are going to be affected. So every situation is different, but just on certain analysis, it doesn't necessarily mean they'll take a big hit, because if they were in the alternative minimum tax on their individual level, they were getting no deduction. So to reiterate, the alternative minimum tax is another way of, is a parallel way of calculating your tax, but it's just disallowing certain deductions. So if someone had high state and real estate taxes and was in the alternative minimum tax, they're getting no benefit. But with this new tax plan, is the alternative minimum tax, the threshold on the individual level is increasing. So a lot less people are going to be most likely in the alternative minimum tax. So this $10,000 cap may not be affecting them that much. Mm-hmm. As well, another one of the big changes was medical expenses. Now, for anyone 65 and under, you were able to deduct it had to be over 10% of your income. So if someone's income was $100,000, the first $10,000 was non-deductible, and the first $10,001, that $1 and up became the deduction. So now they're reducing that threshold from 10% of your income back to 7.5% of your income, which what it was a few years ago. So now more people are maybe able to take the medical expense deduction than in past years. Another thing that's changing, and this affects homeowners, is the home mortgage interest deduction. So if you have a home mortgage up to $1 million, you were able, if the principal was up to $1 million, you were able to deduct the interest, just the interest, off your tax return. Now that threshold from $1 million drops to $750,000. So your first $750,000 of your outstanding principal of the interest, you can deduct. Anything over that is now be deductible. Now, for those of you that have mortgages prior than January 1st, 2018, not to worry, you're grandfathered in under the previous laws, so that part doesn't affect you. But anyone in 2018 from January 1st and on, you're not going to be able to take that full $1 million principal, the interest. If you have an outstanding principal of $1 million, the interest on that is now going to be limited to just $750,000. Now, for those that don't have a mortgage but they have a home equity, also known as a HELOC, you're able to deduct $100,000 of the interest on the principal. That is now being fully eliminated. So interest paid on a home equity loan is now 100% eliminated. So that deduction is gone. Charitable contributions, in past years, you were able to deduct up to 50% of your income in 1 year. So if someone made, going back to my example, $100,000 in the revenue was, if their income rather was $100,000, they were able to give away to qualified charitable organizations up to $50,000, take the deduction in 1 year. Obviously, if they're able to give 50% of their income to charity, God bless them. But now that threshold is now being increased to 60% of the income. So on my $100,000 income example, someone now is able to deduct up to $60,000 in charity in 1 year. But there's also some, with some additions, there's other subtractions. So for unreimbursed employee expenses, tax preparation fees, that is all going to be eliminated. You cannot do any deduction. You cannot take any deductions for that in 2018 and going forward. While in past years, you were able to deduct those expenses if it was more than 2% of your income. So if your income was $100,000, the first $2,000 is non-deductible. The first $2,001 and above, you can take the deduction. So we have some pros and cons depending on a person's situation, where they live, and stuff like and things along those lines. But one thing, Neil, to pay attention is the standard deduction in past years was approximately around $13,000 for joint filers. Now it's increasing to $24,000. So the government's thinking was a lot more people now are going to be taking the standard deduction and not be itemizing. So in terms of the government, the tax returns just got a little bit more straightforward in a way that there's no itemized deductions. It's just a standard and they're done. Mm-hmm. But for those with a lot of children, they're losing the personal exemption, which was saving them about $4,000 of tax per child and dependent. So that's gone. But if you do have children, they made the child tax credit, which any child you have under the age of 17. Now, Neil, this is a big one. In past years, it was a $1,000 credit per child if they qualified based on income thresholds. Now that if they qualify, it's $2,000 per child. So that doubled, as well as the maximum that was able to be refunded, meaning the government would pay back money towards the taxpayer, was just $1,000. That went up by 40%. It's now $1,400. And in past years, in 2017 and prior, the phase out began at $75,000 for someone single or head of household, and for $110,000 for someone married. Now those thresholds have spiked to $200,000 for someone single or head of household, and $400,000 for someone married. So there's potential. A lot more people now are going to be able to take advantage of this credit that they were not able to in past years. So, and now in 2000, and there's just one more credit, Neil, that was added with this plan, in that there's now something known as the adult tax credit. So if you have someone 18 or over that is claimed as a dependent that needs that you claim on your return, you're now able to get a $500 credit for them. It's not refundable. You won't get any money for them, but it's now a new credit that if you have, for example, a sibling you claim on your return, you have someone in college that you claim on your return, you have a parent, now you're going to get potentially a $500 credit, which wasn't there in past years. So, depending on your situation, whether you're a business owner, whether you're a W-2 employee, your taxes are going to change regardless. It depends, on your income. It depends where you live. So it's not a clear cut, this tax plan.
Well, how about a general picture? I know there's lots of pros and cons, and you've just said that it's not really clear cut. But overall, for the individual, would you say this is a good tax plan or negative?
Well, it depends on the individual. Is the individual single or married? For example, if someone is married now, your first $24,000 of income is now going to be tax-free because you take the standard deduction. If you're single now, your first $12,000 is now going to be tax-free. So potentially someone that is on the poverty line, they're going to be paying now zero tax, 100% across the board. And if they have any children, they're going to be getting even more money back from the government. So it's hard to say in general. You'd have to go through in each person's situation to see if it benefits them. I know a major news outlet did a test of 3 individuals, some single, some married, throughout the country, and each 3 of those scenarios, they saved on taxes. Some of them were making low income, some of them were over $300,000. So it just depends on a person's situation. It's not a clear-cut way of saying, yes, this will 100% benefit everyone. No, it will not benefit anyone. It's hard to say depending on their situation. In my personal estimation, my personal opinion, I do see this as an overall tax cut regardless. Those in the higher income will benefit more than those in the lower income. But it's still, this plan is a few weeks old. The IRS hasn't updated their website yet fully for all these major changes and how it'll fully affect the taxpayer. We have a general idea, but we have to first see how it's going to be on the forms, income limitations, and stuff like that. So the IRS has a little bit of time to get everything up to date.
Yep, still figuring things out, and the best person to see, obviously, when you're trying to figure these things out is a CPA, somebody who lives and breathes this kind of stuff and knows what every little decision means. Now, as far as decisions for businesses, I just saw in the news that Apple is planning building a new $35 billion facility here in the United States and taking some of that money that was abroad and taking it back to the United States.
Yes. Apple is one of those big companies where Tim Cook had an interview during this week where he spoke about that with this tax code, with this new tax plan that was put into effect, Apple is now going to be giving bonuses to their employees as well as open a new facility. Now, the question is whether this was already on their minds or the tax plan changed or the tax plan got things really moving is really unknown, and only the people in Apple will know. But one of the main things that Apple did is Apple sells a lot overseas, in Asia, in Europe. So all that money, all those revenue was stuck in those respective countries, and they were not able to bring that money in. And if they were obviously able to, but if they did, they would be subject to the high tax rates of the United States. So in this tax plan, there's something that allows them to bring back any money they had overseas and pay a limited tax rate on that money, a one-time tax rate. And I believe Apple is paying the government approximately $38 billion in taxes to bring all the overseas money. So for the Treasury, the United States Treasury, they just got a nice check for $38 billion because of this tax plan. Well, it's still too early to see how many other companies will be making the switch, but we've seen AT&T give out bonuses. We've seen Walmart give out bonuses because they're saving on the corporate taxes and they're passing that money down, which is the Republican mindset is the savings will trickle down to the individuals. Whether this is just a one-time bonus, a continuous bonus, we'll have to see about that. And it could be they're just doing this just a one-time thing for good PR, because this is great PR when you can say we're giving out bonuses to all of our employees.
And that's, I think, a question that many people have is when you have this extra money in your pocket and there's no rules to tell you what to do with it, there's a lot of companies that are getting the PR for giving, like you said, to their employees the bonuses to make them happy, and hopefully that makes them work better and stronger and faster and gets that company going. But it's not necessarily, other companies might just say, oh, great, I've got extra money, I'm going to put it in the bank, and maybe that's better for the shareholders.
Well, yeah, there's different ways of thinking about it. If the company wants to expand, they'll say, oh, we have less to pay in taxes, and we'll now get a deduction up to $1 million to it for new assets, they might be spending that money. Obviously, some companies may say, hey, we're just going to buy back stock now. So it's hard to say what's in the mindset of the board and the CEOs of these respective companies, but the Republican mindset was they're going to give higher wages, and with those higher wages, that will make up for some of this lost tax revenue by reducing the tax rates. Obviously, there's a lot of hypotheticals. A lot of things have to go right in order for the Republican mindset and opinion to actually prove, and it's going to take years to find out. But,
yeah, we're still waiting. We're still waiting to see.
Yeah, I mean, this tax plan is not even a month old the time we're taping this, and we've seen the stock market crush it week after week. So the economy, the U.S. economy, looks to be very strong, as well as the worldwide economy is doing very strong. So if things continue this way, this could potentially be a nice tax plan that it's going to save the American people money, as well as it's going to save the American people money, as well as potentially expand the economy even more. But there's a lot of hypotheticals that need to go, and that's assuming things are consistent. There's, politically things are consistent and no major changes like that, which is never the case.
Mm-hmm. Well, it really has been remarkable to see just how things have taken off in the last couple of years, especially since Trump got into power, which is great for him, but the economy has really skyrocketed. Only time will tell if there'll be a correction, but having somebody like yourself to actually know what to do in those times is very influential. So to tell us a little bit more about yourself and your own practice. You've given us a bunch of information already, but tell us a little bit about your own practice and maybe some of the clients that you've helped and what kind of outcome that you have let them achieve by working with you.
Yeah, I mean, it's a great question, Neil. I'm one of those accountants, I like to be more involved than just once a year or twice a year. When I was referring back to when we began this, that companies just don't know how they're doing in terms of reviewing their books, not keeping up to date. I remember meeting with one of my clients. I was going through their line of credit that they have with one of the large banks, and I was looking through their statements, and I said, you got charged 1 month $80,000 in interest, and the whole loan is a few $1 million. The whole loan wasn't even $1 million. And I said, this just does not make sense. Like, what do you mean it doesn't make sense? I said, look, your loan at this time was about a little under $1 million. How could they charge you $80,000 in 1 month in interest? Turns out the bank made a mistake. The owners didn't pick up on it. The bookkeeper just didn't pick up on it. And that was an $80,000 mistake. So if you're not looking through your books, banks make mistakes, people make mistakes. That's why this is something I like to get involved with, because I'm familiar with it. This is my specialty, reviewing the books and, doing the numbers. Is the interest rate right? Are you being overcharged? Stuff along those lines. Are you have the best rate for payroll? And I like to give advice along those lines. Another one of main examples of helping one of my clients was a startup. A good friend of mine that was fortunate enough that he brought me on early on. I was handling the books. Then the company got acquired by a major company in America. So they needed someone they can trust. They needed someone that they can trust. And Neil, I remember this. I was representing my client. I was one person at the time. And on the opposite side in this boardroom, where their meeting was in Midtown Manhattan as well, by a large accounting firm, one of the top 5 accounting firms, they had an entire team. And it was just me representing my client. So it was a David versus Goliath moment. Turns out the acquisition went very well. No issues. That was I'm glad to hear. My practice, it consists of doing individual returns, business returns, bookkeeping, sales tax preparations, payroll taxes, representation between IRS, New York State, any of the states. People get nervous when they see bills or letters from the IRS or their respective state. They don't know what to do. They panic. They just, put it in a drawer and hope nothing comes out of it, which is the worst thing you can possibly do. You can really try and run, but you cannot hide from these guys, especially with recent regulations that came out that if you owe a certain amount of money, they could potentially suspend your passport. No one wants to go to the airport and say, and here your passport is suspended. You cannot leave the country for not paying taxes. So things along those lines, helping clients with any notices they have, or just sometimes I just want to get an opinion. Does this make sense? What if I do this? What's the tax ramifications? Retirement is such an important piece that I don't think it's stressed enough, and especially the millennial era, that they think in their minds, oh, we have so many years until to think of retirement. But especially the way, Neil, that the market has been going, it would be a shame if someone didn't get in and enjoy this. Though there may be a correction, but they'll have time, most likely in their working career, to make up for any potential losses. So that's another one of the things that I like to steer my clients is, let's put money in retirement. Let that money grow year after year. Because what's the alternative? The alternative is you put it away for yourself, or it's going to the government for taxes. I'm sure you'd most likely like to put it in your pocket. I've built a team of advisors and outside consultants who we meet at least quarterly to review the latest in retirement planning strategy, stuff along those lines. So I prefer not to be just a once a year type of accountant. I like to be kept in the loop. So if there's something that can change, if any government changes, if your business changes, I like to be along with you. So if you need, for example, you hire employees, you need to get workers' comp insurance, you need to get disability insurance. I've seen people where they send me the letter of a $2,000-$3,000 penalty for not having workers' comp insurance. So I like to be ahead of the game, proactive. It just makes things a lot easier and a lot less headaches for the business owner.
I think you just said it right there. It's a lot less headaches for the business owner. There's a lot that they have to do to run their business. They've got marketing and dealing with employees, and just to have somebody take care or be in their corner, because it is a fight, it is a struggle to, get above the competition and stay in business and do well. So to have somebody that's really fighting for you is extremely important. And especially when it comes to the figures, which a lot of business owners just don't like to do. It's not. Yeah,
for some reason they're afraid of it. They're scared of it. But the only way to really know how your business is doing is to really look into the numbers, dig into the numbers, and see, are we spending too much in marketing? What's the return that we're getting? Is it worth spending all this money? For some businesses, they don't know until it's the end of the year, and it's too late. There's nothing you can do. You can't make any changes if you don't know what's the current situation.
And now is the start of a new year, so it's a great time to get hold of you, Jack, to deal with that for them. So tell our audience, what is the best way to get hold of you? You are in the New York area, but I'm sure you have clients from all across the country and probably the world.
Correct. I have clients from all over the country. I work, if someone's on the West Coast, I'll work around your schedule to accommodate. So even if there's a 3-hour difference, in this day and age, you can't really tell by phone or even email of a time difference. The best way is, to set up an introductory email with me. My email is jack@Husney CPA, JACK@HUSNEYCPA.com. My phone number is 347-450-JACK, 347-450-5225. If you want to, we could set up an introductory phone call, a complimentary phone call at no charge, just to see where your business stands, what services you'll need from me, and my team and I will do the absolute best to take care of you.
Well, Jack Husney, it has been a pleasure talking with you today. There's definitely a lot to find out still about this new tax plan, but it seems to be benefiting a lot of people, whether you're an individual or a business. But ultimately, it's about keeping those books and knowing your numbers. And
it comes down to just knowing your numbers. It's hard to expand if you don't know where you currently are. So
exactly.
It's all about your numbers.
Well, Jack, thank you very much for being my guest today on Business Authority Radio.
Neil, thank you so much. It was a pleasure.
And to our listening audience, if you like what you hear, hit that like button and share, and we'll see you next time on the show.
You've been listening to Business Authority Radio with Neil Howe and Greg Williams. To learn more about the resources mentioned in today's show or to listen to past episodes, visit businessauthorityradio.com.